Fortinet got hammered last week after announcing earnings. If the month was to close today on the monthly chart, price would be below the 13 simple monthly moving average. On the weekly chart, price would be below the 13 and 26 weekly simple moving averages, and on the daily chart, prices would be below all moving averages, including the 200-day simple moving average. Before we get into the analysis, and before I tell you the zone where you could buy, let's get into the article. This is coming from investing.com. Fortinet tumbles 18% after cutting full year forecasts. So Fortinet shares fell as much as 18.8% in pre-market Friday. Obviously, when the markets open, it fell much further. After the cybersecurity company reported weaker than expected billings and revenue for the second quarter, this underperformance prompted management to also lower their full year forecasts. So the CEO says, as a leading cybersecurity platform and secure networking vendor, we remain well positioned for strong long-term growth as companies increasingly look to consolidate vendors and point products. Don't you just love how all CEOs state the positive regardless of the situation? He goes on to say, we are one of the top market share leaders in both SD-WAN and OT, and we will continue to focus on our key long-term growth markets of secure networking, consolidated cybersecurity fabric, hybrid cloud security, and operational technology, which has a combined total addressable market in 2023 of 122 billion. All right, so let's get into what the analysts think. TD Cowen analysts downgraded the stock to market perform on soft print and outlook on the basis of perimeter firewalls could be seeing a post-COVID slowdown, enterprise slowness, and the last one, exposure to service provider vertical. That is the top Fortinet vertical, could be facing macro pressures. They lower their price target 270 from 90. On the other hand, you have Morgan Stanley. They cut their price target by $4 to 80 per share, but remain overweight. Nevertheless, they cite, while disappointing Q2 result, we remain bullish longer term and expect billing growth to reaccelerate through fiscal year 2024. All right, so let me just give you the zone where I'm anticipating a bounce, and that's going to be the level at $52. Now this zone is pretty large, and when we get to the daily chart, we can probably make that more. All right, let's make it. Okay, here's the zone. This is the weekly bias level. But here's what I'm going to do. I'm going to shorten that zone, and I'm going to say you got to put your stop loss below the low of this candle here. All right, let's talk about it. Let's just put this in red. All right. So you had a rally in price, a basing candle, and a rally out. So leg in, basing candle, leg out on above average volume. Although I'm not in love with all the trading to the left of this level, explosive move higher. It is a level that has to be respected. So let's put in weekly buyers at $52. Here's the trade setup. Before we do that, let's confirm some things on the daily chart. Yeah, so this is a gap here. Right. Okay, so that strong extended range candle was on earnings. Now price, I'm anticipating price to continue going down to fill the gap. Right, there are no buyers until we get to the $52 level. All right, so the daily just validated the setup. Look for price to continue to move down, but then look for price to bounce higher. With the first target at the $60 level. As a first target. Can price continue to rise? Most certainly. That's a gap fill, right? Let's go to the daily chart. And so that $60 level also is right below the 200-day moving average, which now serves as resistance, dynamic resistance. But I'm looking for price to continue to decline $4 more before the weekly buyers step in and move price up to, again, the first target of 60, and potentially over time, maybe the next 12 to 18 months to fill that gap. Thanks for watching. Subscribe. Please like the video.